What is up, YouTube? I'm Adam O'Dell, Chief Investment Strategist at moneyandmarkets.com, and I'm joined by my research analyst, Matt Clark, and we're here for another episode of Ask Adam Anything, where we field questions from either the YouTube comments down below or our email address for our paying or unpaying subscribers. And we're happy to answer any questions you have about the markets in general, about specific stocks. We do have a 6-factor stock rating model that's available for free to use on our moneyandmarkets.com website. So you can certainly check out the ratings there. But if you want to know either my opinion or Matt's opinion on a specific stock, certainly leave us a question in the comments. So we're doing this every single week, and we certainly want to answer your most pressing questions. So with that, Matt, I'll let you take it away this week.
Absolutely. And thanks for joining. Yeah, again, as Adam said, if you do have a question about a particular stock or maybe a sector or maybe something that's moved the markets or made market news, and you want to get that unique insight for either Adam, Charles, or myself, email us. That email address is feedback@moneyandmarkets.com, or you can comment down below here on YouTube. We love to see feedback. We love to field questions. We love to hear kind of how you're doing with things. So, email us anytime. Love to read it. Now today, I'm going to take a little bit different approach, and I want to kind of focus on, I guess, current events and really get your perspective on some things. Over the last week or so, what's been dominating market headlines have been very big tech stock earnings. FANG stocks, Facebook, Google, Amazon, Apple, Netflix, even Microsoft, all these companies have reported earnings. And these are companies that are big enough to where they themselves will move markets. We've seen it. We saw Google's beating their analyst expectations, went up exponentially, drove the market up. On the flip side, we've seen Meta, Facebook. It actually fell short of expectations, moved the market down. These are companies that are big, they're popular, they're widely known, but I want to kind of get your perspective on each one of them. So I named off 6, and we don't have to get too deep into them, but I guess I want to start off first. I'll start with Facebook. That's a good place to start. They've been the most prominent in the news of late because of their earnings miss, and they dropped, I believe, $200 and some billion off of their market value in just about a day because of their market miss, of their analyst miss. So let's start with Facebook.
Yeah. So first of all, it was actually the largest one-day loss of stock market value of a single stock in the entire history of the stock market. So pretty interesting there. And if you look back at the charts, shares of Facebook. And by the way, I'm not a boomer. I'm the oldest millennial out there, but I'm not a boomer. But I've been doing this long enough. I will still call Meta platforms Facebook, and I will still call Alphabet Google. So apologies for that if it's necessary. But yeah, I mean, shares of Facebook or Meta are now less than 5% above their pre-COVID peak. So we have all of these stocks that have just been rocketing past, their Corona crash highs, of February 2020, and yet the drop over the past few days, past week or so, in shares of Facebook have brought it almost wiped out all of those post-recovery gains. But I have to admit at this point, I've never been a fan of Facebook, and you can like me or hate me for that. But I've just always had a bias against Facebook, and you're not supposed to invest on your biases. But I've also kind of made this point before that if you're in love with a company and you invest in them because you're in love with them, I feel like that's more dangerous than if you hate a company and choose not to invest in them. You may miss out on a big opportunity if that happens, but you won't necessarily ride something down to zero. So I will say that. But Facebook for me, I mean, I was in medical school. I did 1 year of medical school before I did a pivot. I was in medical school in 2005. Facebook came out in 2004. And I specifically remember being in lectures, in actual classes. We didn't do Zoom back then, but in actual lectures where people had their laptops open, taking notes, and seeing people on Facebook and hearing everybody talk about it. And I wasn't into it. And throughout the years, I still do not have a Facebook account. I've never been on Facebook. So I'll probably get railed for that. But, obviously Facebook has had to do a major pivot. They see that their active users are declining now. Folks like, platforms like TikTok are kind of, grab the attention of the younger generation. So they've had to do a major pivot. They pivoted to this metaverse. And I'll be frank here as well, I don't really understand the full potential of the metaverse. Are things moving more digital? Are things moving more online? Is a lot of the economy about community and attention economy? Yes, absolutely. But I just don't see the metaverse replacing the real world economy globally across the board. So I think that at this stage of the game, there's more hype in it. For me personally, the fact that Facebook is pivoted to that, not only in their name, but in their investment and capital spend, it's a little bit concerning, because I look at the other side of the coin, and I look at a company like Alphabet, formerly known as Google. And if you look at their subsidiaries, if you just look at their subsidiaries, they have one on artificial intelligence. They have one on drug discovery, which those two are intimately involved. They're basically using artificial intelligence to speed up the drug discovery process and make it far more economical, which means a lot more profits for the drugs that get brought to market. So they have a human health division, autonomous driving, drone delivery, venture capital, as well as their Google search. So obviously those are a lot more real world subsidiaries, and I would much rather invest in a company that has a number of irons in the fire, so to speak, across real world industries, even if they are cutting edge technologies, rather than just a metaverse type of play.
And I would say the competition for a Google search is much less than the competition is for a Facebook account. I have a Facebook account, hardly ever use it. It's not my thing. Nobody cares what I had for breakfast this morning. So I just don't really get into the aspect of it. But as a company, I'm kind of with you. I mean, I think social media was big. They obviously capitalized on that when they first came out in 2004. But now there's a lot of players in the game here. There's a ton. You've got, not to mention, Twitter, but TikTok, and even there's nation specific, Weibo in China. There's a lot of these companies out there that are really branching into social media that is niche for specific segments of the population based on similar interests.
Right.
And I think that's going to draw a lot more support and a lot more interest from individual users than a broader platform like a Facebook. But that's just me. And Google, I love the diversity. I love that they have. They're not trying to dominate, but they're trying to innovate. And I think that they're doing it very smart with their level of investments. Now, we've talked about Facebook, talked about Google. Real quickly, let's talk about Amazon. Amazon.com. Here's another big company that has really kind of transformed itself over the years.
Yeah, I mean, it's hard to knock Amazon and their dominance in what they do as far as e-commerce, and they basically brought that industry, light years ahead. But if you look at the stock charts, I mean, they've basically gone sideways since late 2020, and then they had a pretty severe drop. Their recent earnings report was rather favorable. They've doubled their workforce and they've doubled their net profits over the past couple of years. So, I don't want to bet against Amazon. That said, the chart pattern is a little bit concerning. You saw it basically fall through a consolidation, the lower bound of a consolidation pattern. Obviously, the earnings report, and we've gotten a bounce in tech stocks over the last week or so. So that's brought it back up a bit. But honestly, I mean, they do have a lot of recovery to go. We need to see 3,600 broken on the upside before we'll have a new uptrend in that stock. So that could take a while. The other thing, I mean, viewers should know that if you go to moneymarkets.com and you click on the upper right corner, therethere's a little search box there, and you can type in the ticker symbol of any stock you're interested in. So go look at the big tech, the FANG stocks there. You'll see that of the FANG stocks, Google is rated the highest. It earns a rating of 88 out of 100 last time we checked, and that's the highest of the FANG stocks. Second highest would be Microsoft, and then the third place would be Apple. Interestingly enough, Amazon rates the lowest with a 40 out of 100. So some of that is due to size. All of these tech companies get dinged on size. Historically speaking, smaller companies, small cap stocks outperform in aggregate over the long run large cap stocks, but clearly that has not been the story or the actual trend or reality over the past 5 to 7 years, when large mega cap companies have outperformed. But Amazon gets dinged on momentum. That's largely because of the chart pattern that I talked about, and the rather high volatility. And then all of these big FANG stocks are trading at very rich valuations. I mean, Facebook and Google aren't as bad. Netflix isn't as bad, but if you look at Amazon, even Apple and Microsoft, they rate in the low teens out of 100. So they are very richly priced at this point. And eventually there will probably be a rotation out of mega cap tech and into smaller cap stocks and into other areas of the economy, other sectors. So I would be, if you own index funds, you own these stocks already, I would be hesitant to go too deep into any one of them beyond that, other than in our flagship newsletter, Green Zone Fortunes, I will disclose, we don't typically do this, but we did just do a recommendation on Google because of their artificial intelligence and drug discovery unit, which we feel, as you know, Matt, is very underappreciated by the market, and it's going to drive innovation and shareholder gains over the next decade or so.
For sure. And the one thing is that when you look at these 6 companies, Facebook, Google, Amazon, Apple, Netflix, and Microsoft, all but about 2 of these companies have had to pivot from their base of what they started. I mean, Google has a Google search, but now they are, transitioning into more exploratory type tech. You have Amazon. Amazon started as a bookseller, as a book, and they branched off into be e-commerce. But you also have this kind of, it's talked about, but not really as much, and that's AWS, Amazon Web Services, which has become a big driver of revenue of late, as companies are looking at big data, big storage, things like that. Amazon Web Services. You have Apple. Apple started off with the Macintosh computer, and now they're pivoting to much smaller. The Apple Watch, the iPhone, all these other things, as well as app development and things like that. Netflix, not so much. Netflix has been a kind of a steady. It's been steady in what it does. It's kind of branched a little bit into being more of a studio, if you will, and producing films and content for its streaming site. But I think that's because the competition for this streaming content and the licensing of that content has become so tight that in order to get fresh content, Amazon or Netflix kind of was forced into becoming a producer if they wanted new things on their platform. And then you have Microsoft. Microsoft, again, this was a company that was leaning heavily into operating systems with OS. But now, even just of late, $70 billion to buy Activision Blizzard. So now you see a little bit in tune of what the business is looking for, and that is pivoting more towards maybe an online presence, so a little bit more into gaming a bit, maybe to boost up its Xbox, its Xbox series with its gaming system. So, the smart companies are the ones that realize that maybe the market they started in may be a little too dry, so they try to pivot smartly into something that they can find more profit in. And still keep kind of pumping into that original thing, and I think you see that especially in terms of our Green Zone rating. The three companies that score the highest with Google, Amazon, Google, Apple, and Microsoft. These are the 3 probably most innovative of the 6 tech stocks that we've talked about.
They've expanded, and I would question the use of the word pivot because, in my opinion, or the way I see it, Facebook and Netflix have had to pivot. They've seen the writing on the wall that their traditional business model, which was disruptive 10 years ago, is to use your words, dried up a bit. And so they've had to actually pivot to an area where they think is going to be better for the next 10 years. Whereas on the other hand, Google and Apple and Microsoft have been able to retain their core business. I mean, Google search is not drying up. I mean, and Microsoft's hold as an operating system at the enterprise and personal level is not changing. So they've basically just been able to harness those free cash flows to invest in other businesses and expand and become almost become conglomerates, so to speak. So we'll see how that goes. I mean, obviously GE didn't do so well being a conglomerate of the past generation, but we'll see how the Googles and Microsofts and Apples do in that sense. But yeah, I mean, I think certainly pivot's the right word for Facebook. They realized that to be an ad-driven, almost solely social network when other platforms are taking market share was kind of a downhill road, so to speak, or maybe an uphill road. So they've certainly had to pivot. So we'll see if it turns out. Certainly I know folks that bought Facebook back when they IPO'd in 2012, and they've done all right. So it's not like it's been the worst investment overall.
Yeah, none of these stocks none of these companies are bad companies. It's just you have to look deeper and look at the business model. What are they doing? How are they doing it? And how is that translating at the end of the day to their balance sheet? And that's where you're going to get a real picture. I mean, these are all well-known names. I would venture a guess to say everybody knows the 6 names that we've talked about. No one is scratching their head going, I wonder what this Apple thing is they're talking about. No one's doing that. So, when you're dealing with big companies like that, it's very important to get more insight to get more analysis on what these companies do before you decide what you want to invest in. Adam, I really want to get your perspective on this. I think it was great insight to have. I think anyone who's looking to potentially invest into any of these companies or maybe holding these companies right now, I think it was good information for them to have to kind of figure out what the future lies ahead for any of these companies. So I appreciate that. Again, as Adam said before, if you want to look up, and get our proprietary stock rating system, our ratings for any number of stocks, thousands of them, you can go to moneymarkets.com. Up in the top right-hand search bar, just type in any ticker you like. You can even type in the company name, and you'll be able to see exactly what their rating is as of right now. Plus, you can see the breakdown of the 6 metrics that we use and how each company rates in each of those metrics. Plus, a wealth of other things, stock charts, some fundamental data. And anything that any insight that we've written about, either Adam, Charles, myself, or any member of our team have written about related to that stock. It's all right there, and you can use it all for free at moneymarkets.com. Also, we talk about Green Zone Fortunes. We're going to put a link up there so you can find out more about our premium research service. That is Green Zone Fortunes. Adam, Charles, myself, our team, we work to give you even more analysis, even more insight, and even more depth, as well as that one stock pick a month that we believe is going to beat the market by 2 to 3 times over the next 12 months. You get all that for less than the price of a cup of coffee in your inbox for that, and we'll give you more information on how you can get into that. So Adam, again, appreciate it. Look forward to doing it again next week, and we'll talk again next week.
Sounds great, Matt. Thanks a lot. Talk soon.